Is there a place you can actually keep your money that will be safer than the stock market and get a better return? I'm not just talking about real estate investing, guys, although that's cool too, but I am going to talk about something else where you could actually be storing your money right now. Hello, my fellow Ripplers. This is Chris Miles, your cash flow expert and anti-financial advisor. This show is for those of you that work so hard for your money and you're now ready for that money to start working harder for you today. You want that freedom. You want that cash flow right now. You're not waiting 30 or 40 years for it. You want it today so you can live that life that you love, that with those that you love. But most importantly, guys, you're not just in it to get rich, although that's a cool perk too. But you're here to live a rich life because as you're blessed financially, you have a greater capacity to bless the lives of those around you. Thank you so much for tuning in today. Guys, I really appreciate the fact that you've been tuning in. You've been binging on these episodes. And not to mention, many of you have subscribed to our YouTube channel and actually been watching a lot of these other videos too. So thank you so much for being a part of our community and really allowing me to create that ripple effect through you. If you haven't done so already, guys, and you're looking for ways to create passive income right now, go to our website, moneyripples.com. There's a passive income calculator that you can try out to see how much passive income you could create in the next 12 months. Many people keep asking, how do you get those numbers? How does that even come up? It's literally from the numbers I would calculate for people myself from my own brain. Now it's in the calculator, so you don't have to keep emailing me, Chris, how much could I do in my situation? You can literally in just a few minutes find out for yourself. Go check that out at moneyripples.com. All right, guys. So I'm bringing back Parker Jardine here today. Parker, if you don't know who he is, and some of you already do, because if you're following us and you're clients of ours, you know who Parker is because he's the guy that I often will send people to for infinite banking. So when we talk about infinite banking, using whole life insurance and as a way to not only just have tax-free supercharged savings, but also be able to create money in two places at once, he is the guy that we talk to. And so I wanted to bring him on right now because we're kind of noticing some shifts happening, very subtle shifts in the things that you guys are prioritizing, what you're asking, the questions you're asking about this and what you're really wanting right now. Plus, guess what, guys? There's something coming up now. There's a lot of people in the markets today saying the stock market may not do as well as you think. And that's what I want to talk about with Parker today. So welcome back, Parker.
What's up, gang?
So give them a little bit your backstory, even specifically. I mean, I know you've had an entrepreneur background. I know your dad's been a big time entrepreneur, even invested in stock markets. I know you've even done trading yourself in the stock markets and whatnot. But tell us a little bit more about you and even how you started becoming a kind of a raving girl fan of infinite banking and whatnot.
I am a raving fan, absolutely. And I've been on both ends of the spectrum from safe and conservative on the insurance and guaranteed side, all the way up to day trading thousands of people's accounts doing, I think one of my best months was like 400%. It was the most
That
euphoric
sucks.
I've ever been. Yeah. And then it doesn't matter how good you do one bad trade and man, you don't hear the end of it. And so it's the most depressed and euphoric I've been all at the same time. So no longer do much of the day trading, still little trades here and there. I like a little spice and a little risk, but I like the safety and security that comes with insurance and then build on that with all the other kind of investments and things that we do. So,
How
but
did you
yeah,
first learn about it?
well, that takes me back almost 15 years now as my oldest policy. And I got lucky. I was a hard worker as a young kid. And I think my first job was 13, 14. I'd get up at 5 a.m, drive to a job site, mix concrete and mud and carry bricks for a hod tender for brick masons. So it's where I learned
Wow.
to get a strong back and also learn some swear words. So that was a good entry into the workforce. And but from there, my dad was always in finance and business and entrepreneurship and traveled a lot during our childhood. And I was always kind of fascinated with money. And that's what he did. Taught seminars all over the world, teaching people how to invest on their own back when you could kind of start to do that on your own when the internet was coming out and all that. And so I thought that's kind of what I would do. And I went into finance and economics in school and learned nothing about money except for how to get a job at, maybe one of the big banks. Came back to how I actually ended up paying for school or financing school, and that was through insurance. which all of my brick mason, mowing lawn, delivering pizza money that I had just been a good saver, ended up put into this specially designed insurance contract, which I actually didn't have to put on college forms or FAFSA or effective family contribution. So it didn't count against me for school, and actually helped because then I could qualify for Pell Grants and student aid and scholarships to actually lower the cost of school, and as well as qualify for, I believe there's subsidized loans or Stafford loans,
Hmm.
where I didn't have to pay any payments or make any interest payments until after graduation. And so instead of using my savings, which was getting put into these policies, which I guess now was my college savings, but I don't think I was thinking about that at 14, saving for
Hmm.
college. And I actually borrowed the government's money for free to pay for the rest of school and tuition and books and fees. And so I actually didn't have to touch my college savings to pay for school. And that helped me be able to leverage somebody else's money. And then when I was eventually done with school, all the money that had been growing inside of this tax-free insurance plan, I could just refinance that student debt. And so I actually ended up making money on my education by financing it through insurance. And so from there, I just kind of got hooked, and I've just been buying policies ever since.
Well, explain that. Like, how did you actually make money? Because I mean, insurance, most of us hear it as just an expense. How are you actually able to make money off of your schooling?
Yeah, so I think it was two ways. One was because the money was in there, I could reduce the cost of school and
Mhm.
use, Stafford loans to pay for school without having any cost or interest or payments due on those.
Yeah.
So I think that's one way that it helped make money, by lowering that overall cost. And then the second way would be, obviously I'm earning guaranteed interest and dividends tax-free inside of my policy. And even
Mhm.
when I refinanced what little student loans I had left after school, then I was still earning interest and dividends on that cash in my policy, as if I never took it out in the first place to actually spend and pay for school. Uh,
Right.
and so that college savings plan, has now become an account that I've used for homes, cars, investments, vacations, refinancing high interest debt, doing a book with my dad, all kinds of stuff.
Yeah. You've made countless ways you've made money with that money, huh?
Exactly. Yeah, it just keeps turning over, and that dollar just keeps serving, me in more than one way.
Well, that was like the same what you had already understood and actually applied in your life. The same thing I was trying to explain to my 18-year-old daughter recently. Because,
Yeah, I remember talking about that.
yeah, she was like spooked, scared to death, even trying to like get us any kind of loans, right? She's like, "Oh, I don't want to get any loans. My mom told me that loans are bad." I'm like, "Yeah, but what if you could actually have that money set aside somewhere, and literally be making money and making interest on that money while you're not paying interest on those loans, or paying anything for that matter for years into the
Yeah.
future?" And she's
Well, I think
like, she kind of got it, but it was like scary to her because she was taught that debt was always evil,
it is, especially at a young age, and all we hear about is how, student debt and car loans and credit card debt, and people are just consumed by payments and interest and enslaved to these companies. So yeah, I don't blame her.
Well, the ironic thing is she's trying to pay it on a payment plan while she's going to school. So it's like, that's basically a debt payment. You're just paying it more aggressively. But when if you could spread that out or even just not make any payments, pocket all that cash to then earn more money than what you're getting charged, and
Yeah,
that was a
100%.
foreign concept for her, even though
Well,
I'm her dad.
yeah. Come on, Chris, get on that.
I know.
Well, and I think that's what helped me in school. Even though I probably did a little more, snowboarding and rock climbing than I should have, relative to education and going to class. But
Mhm.
um, with not stressing about paying for school, I think that also helped influence not only my experience, but also my education, and being able to focus on school and not stress about, hey, now I got to go to work and make payments, to the student debt, and have that distract me from the reason that I'm, going to school or getting an education in the first place.
Yeah. Now you're seeing people actually use this instead of a 529 plan, right? Like I know we've been seeing more and more requests, not just for getting on their kids, but even like people want to get for their grandkids too. I know you've
Oh,
seen that as well.
yeah, absolutely. I mean, you better believe when we had our little girl who's, coming up on 5,
Mhm.
she's got a couple policies, and that's one of the big goals or intentions of using that money. It doesn't have to be just for school or just a 529 plan, right? I think a
Right.
lot of us get sold one silver bullet for one problem that we have, and we end up with, managing all these different accounts that all serve maybe one purpose. And that's what I love about these plans is, the policies for my daughter are not just an alternative to a 529 to help finance her education. I've already used her plans to prepay for preschool and get a discount on her education, even at such a young age. And still earn interest on that money as if I never spent it in the first place. And so it's her
Yeah.
first car fund. It's her daddy, I need a new bike fund. Okay, let's learn how, payments work. How are you going to pay me back or pay yourself back into this policy to pay off the money that you borrow? Uh, it, I don't know what college is even going to look like, in 15, 20 years when she
Right.
goes, but either way, a big part of that money is set aside for education. Maybe she gets married earlier, so maybe it's a wedding fund or first down payment on a property. And then eventually I'll turn some of these over to her to manage. But hopefully along the way, she'll have the education and principles and philosophy that come along with using these plans, so that it's not just, hey, dad was a good saver and here you go, here's some money, go do whatever you want with it. There's
Right.
some guidelines there.
Well, it's kind of like that book Die with a Zero, right? Or the
Yeah,
book,
great book. Yeah.
yeah, like a lot of people keep talking about trying to leave inheritance to their kids when they're possibly in their 50s, 60s, or even 70s, right? If
Uh-huh.
people live longer. And how many people said, I wish I would have inherited that money when I was in my, mid to late 20s or my
Mhm.
30s, give me a better leg up in life, right? And like you
Definitely.
said, like this is money that you can dictate how it's used. It's your money, right? Even though it's in her name. But she's just the insured. You're the owner. You're the one that pays into it. You're the one that has all the control. But you could turn over ownership to her at a certain point, even if it's like when she maybe is later on. Especially because I know with all my kids, they have different levels of financial acumen, right?
Mhm.
And some you could trust with money. You'd probably say, okay, I foresee in the 20s they could be a good steward of that money. Where others could say, yeah, I don't think I even trust them in their 40s at this rate.
Yeah, definitely too early to tell, but I think that's ultimately what it'll be. It'll be somewhere in that late 20s, early 30s after you've kind of started your own family, maybe made a few mistakes and had some
Mhm,
lessons learned, and but along the way there'll be different milestones throughout her life or my other kid's life. We got a little one coming in a few months here, and you better believe I've got that policy printed out, ready to go 30 days after she's born. And there'll be these different stages of their life or rites of passage to help
mhm.
prepare them for those later things in life when they are on their own. And this will hopefully be a tool that will help them and not hurt them.
Yeah, I don't know if you heard the stat. I actually just heard the stat back in December, and they were talking about the average age when someone buys their first home, and
Mhm.
it's for a long time. It's been right around like 32, 33 years old. It's been about that average age. Well, it's now shifted to 38 because
Wow.
now with prices skyrocketing, interest rates going up as well as those prices. Now it's priced so many people out. Now they're having to wait longer to even get to that first home. And I know a lot of people have been using this saying, worst case, even if I don't use it for education, this could be the down payment that can get them into a home earlier than when they're almost 40, if you think about that.
Yeah. Yeah. And I don't see how that's going to improve anytime soon. It's tough.
Yeah. Yeah, I know. By the way, congrats on you getting your new home right now too.
Well, and I was able to get a nice deal on it and act quickly because I could pull the money from insurance to close quick and get another 50,000 off the price. So
Yeah,
it's
how so? Tell us about that.
just being able to move quick and be able to close quick. So we closed in a brand new build. They were having trouble getting rid of a little bit more inventory, and uh, and so I came in at just the right time when the house was little less than a month from being completed.
Mhm.
And so brand new construction home, and I was able to get another 50,000 off the asking price, and that made obviously the high interest rate okay because of the
Mm.
neighborhood that it's in a new development. And I think it was, I mean, it was a little over a week, and I want to say it was like 10 or 11 days we were able to close. And so money talks, right?
Yeah.
And that was able to get us a great deal on a new home.
That's because you have the collateral there to show, "Hey, I've got, enough cash put as down payment," or what was it that you were able to leverage there?
Yeah, so I mean, it was completely opposite to my education, right?
Uh-huh.
When it didn't count against me, that helped. But now when I needed it to count for me, it absolutely helped. And so it showed not only that I had, you know, money just in
Mhm.
general, and assets, but also liquidity, that it was money I could get to quick.
Right. I remember when I was a mortgage broker, that's one of the things that kind of awoke me? Is that even the right word? I was
We're
awoken to, right?
careful. We're not talking not a woke
I didn't get
conversation,
woke.
right? Okay.
But one of the things that surprised me when I would do a mortgage application, this is like over 20 years ago, and even this is actually a time when I was insurance licensed. But what surprised me is that when I'm filling out the mortgage application, they ask for illiquid assets, right? Like 401ks, IRAs, and everything that's typically locked up, even real estate, equity and things like that. But then they ask for liquid assets, it's checking, savings, money market, and then life insurance cash value, which is literally like what counts as a liquid asset. And now I actually use that as I don't even use my bank statements anymore. I just send them a statement from my life insurance, say, here's my reserves. You good?
Mhm.
And they're like, yeah, check, moving on.
Yeah, so it helped immensely.
Yeah. Well, let's talk about some more things. I mean, I know we've talked about using this as money way to make money from real estate and investing and double dipping and things like that. Let's talk about it on the show, but let's talk about some things that maybe we don't always mention. Like for example, what are some of the common things you're being asked right now, or maybe you're seeing people prioritizing more right now?
I mean, everyone still wants to get a great rate of return, and
Mhm.
it's hard sometimes not to chase a rate of return, but I think a lot of people are becoming a little more cognizant that that's not what it's all about, because maybe they've been burned in the past trying to chase a
Yeah.
return, and it doesn't matter how great of a year or a month or quarter that you have if it goes away, and you can lose it.
If you've been following this podcast, you're probably looking for great ways to create passive income right now, right? Well, we got you covered here with Central Lending. Central Lending specializes in alternative investments that actually are designed to create steady returns and long-term financial security for you and your family. Now, they prioritize transparency. They love, building those strong relationships, giving you that confidence and peace of mind, knowing that you have your money working harder for you, so you don't have to work so hard for that money. You want to learn more how to do that? Go to centrallending.com and check out what they've got today to create your passive income and wealth creation right now.
I think one of our good buddies says, when the risk of ruin is present, rate of return is irrelevant. And I kind of like that mantra. And so I think some people are being still, aggressive, and they need cash flow and rates of return. But I think a lot more people are seeing the value of having reserves and liquidity. And so just, I think, being a little more aware and paying a little more attention to having reserves, and not just your typical 3 to 6 months of expenses. People use their policy for a lot more than just that level of reserves, and it becomes, reserves at a much higher level, or maybe even a year or multiple years of reserves to see them through difficult times, or jump on
Mhm.
opportunities when they show up.
Right. Exactly. Yeah, I've noticed that more lately. I mean, we've seen this kind of be a priority with some of the clients are looking for a good savings plan outside of a 401k, so they have control of the money, so it's not locked up in prison, so to speak. Right? They got
Mm.
access to this money that you can get to. Many people ask how quickly. Usually about a week or so, you can transfer the money from here to your bank account. So that's why I keep most of my money in reserves there. But even like some of our higher net worth clients, and even friends, people that
Mhm.
we've talked to that have been using this strategy for years, more and more of them are trying to get not just hundreds of thousands of dollars in here, but even millions of dollars that will leave in here. Like we have one friend that literally he's like, I've got $4 million. I don't plan to use this to invest one bit. He's like,
Mhm.
I'm just literally with all the investing I'm doing, all the risks I'm taking, I want this money to be certain to always be there. And I'm seeing that more and more. Are you starting to see that too?
Yeah, I love the visual, because how I imagine my policies is like this, you know, out of town by the docks, this giant old warehouse that, nobody would suspect, and then you open the big heavy door and there's these big tanks, and I feel like that's where these life insurance policies, where I'm storing the capital, right?
Yeah.
And so it is kind of this war chest money that serves multiple purposes. But yeah, I'm finding more people, because I think a lot of people get into this, concept or strategy, and they want to dump all this money in and pull it out and go do all this stuff with it.
Mhm.
And I'm finding more and more people are starting to allocate more funds towards this bucket and be okay with capital sitting inside of a policy, because it's not the kind of cash that just sits in the bank, earning nothing, paying tax, burning a hole in our pocket. and it feels more productive and a lot more valuable, even if the cash is just sitting inside of a policy.
Right. Well, and that's kind of come to the title of the show, right? We're talking like the question is, could life insurance actually pay more in the stock market?
Mm,
I've seen a lot of articles coming out lately where the projected 10 years by some of the bigger institutions like the Goldman Sachs and Chase and people like that are starting to predict anything like 3, maybe 4, maybe 5% a year as the average per year for the stock market over the next 10 years.
yeah.
And I've seen a lot of people now shifting over to here. I mean, because I used to be told, back in the day that when I was a financial advisor, right, that whole life only paid 1 or 2% a year.
Hmm.
That's not true, is it, Parker?
Yeah. I mean, I've only been doing it for about 15 years, but that's definitely not what I've experienced.
Mhm. Well, what are you seeing as like the dividend rates right now?
Yeah, I mean, it's an interesting year for insurance because if you look at the grand scheme of things and just the overall economy on a national level or global level, there's just a lot of uncertainty and interest rates and what's the Fed going to do, and we got a new president coming in here. I don't have to worry about the money in these policies, and what's great is the dividends actually just went up on
Mhm.
policies for most of the companies that we write business with or that we have policies with. So they're in that. Most of them now are in the 6% range, 6 to 6.4%.
Yeah, that's pretty significant. I mean that,
Yeah,
and that's tax free,
exactly. Which so that what's the real rate of return, right? Not
right?
the gross rate of return. Because what wasn't it? Charlie Munger, I feel like he said, didn't he say something about the stock market too over the next decade or something? He was saying to be, expect a lot less, basically.
Yeah, yeah, yeah. Pretty much the heyday of being able to. Well, he was saying this more in reference to stock traders, especially, or people trying to make a lot of money in stocks. He's like, yeah, that day's over.
Yeah,
Like the best days are behind us, is what he had said. Yeah.
yeah. Or I mean, it hasn't Buffett. What's he up to now in terms of cash? 100 something billion, hundreds.
I think over 325 billion the
Yeah,
last I
it's
saw.
insane.
Yeah, let's see what it is in January. We should be coming out with new numbers for January, but in
Yeah,
December it was 325 billion sitting in cash. He'd sold off a bunch of Apple, some Citigroup, things like that.
yeah. So it's like, what's he preparing for?
Right. Yeah, it's true, huh? What's his war chest building up for, right?
Yeah, that's next level.
Yeah, you don't have to have $300 billion, but it does make you wonder, well, what should I be building up some of this cash for?
Yeah,
Well, and
exactly.
he's primarily in companies, which are traded on the stock
Mhm,
market. So obviously he's definitely seeing a lot less value in the stock market right now. And
mhm.
no, I mean, I don't know why. I mean, 16 years since 2009, if you've been tracking it, only 1 year was down. The other 15 were up. That's pretty unusual.
Yeah, and it makes it hard to get out of stuff like that when everything's been so good. You just think it's going to keep going
Hmm. Well,
until
apparently they're
something
saying
happens
otherwise.
that we're not ready for. We can be as
Yeah.
prepared for things that have happened, but not for something that hasn't happened.
Yeah. Well, in life insurance, how are the interest rates decided? Because it's not based on stock markets and things like that. What do you see it being decided by?
The interest rates on borrowing the money.
No, interest rates on the dividends, just how they pay.
Oh yeah. So I mean, all these guys have contractually guaranteed rates that you're locked into for the life of the contract, which is how I like to talk about it. It's a contract, right? It's not an
Mhm.
investment, and so there's that contractually guaranteed rate, which most products right now pay about a 3% guarantee that we use. So that's kind of your worst case, which is a great place to be. And then on top of that, they pay a tax-free dividend. And the dividend's usually comprised of a few different components. These are obviously mutual companies that we use, so they're not publicly held. You can't go buy stock in these companies. By becoming a permanent policy owner, now you get to share in the ownership of the company as well as the dividends that are paid, which is
Right.
usually based on the company's overall expenses. Were we profitable as a business? How many people died this year? Did we have enough set aside in reserves to pay our promises? Was there any excess to pay in the form of a dividend? And then the other lines of business or investments that they have, were those lines of business profitable? Was there enough to go around, pay our thousands or sometimes even tens of thousands of employees, and
Mhm.
and was there any excess that we could pay in the form of a dividend? So that other so like if dividends right now are at that 6%, 3% might be that guaranteed rate, and the other 3% may be the non-guaranteed rate. uh,
Mhm.
non-guaranteed might scare us a little bit, but that's why we only use companies that have paid a dividend every year for, 150, 163, 175 years consecutive.
Right. Exactly. So when they pay a dividend, when they say they've paid a dividend, that's above the minimum guarantee, right? And
Correct.
so like you said, pre-Civil War, these companies have been paying every single year through depressions, recessions, world wars of all sorts, right?
Hmm.
And still they're paying.
Yeah. So if these don't work out, then there's probably a lot of other bigger problems that we have to worry about. We're not too worried about our insurance.
Right. Well, and that's one thing too, is that I've heard some people say, well, you know what, right now, because the stock market doesn't look as good, let's go to treasuries. And we're starting to see that happening.
Hmm.
But what's ironic is guess where life insurance companies are putting their money into that pays you a dividend. Treasuries, bonds, government bonds, and things like that
Hmm.
of that nature, right? So a lot of times people will say, well, should I put my money in treasuries? I'm like, you could. And yeah, some of you have some tax advantages where you might get state tax that's exempt or federal tax exempt. In this case, you get federal and state tax exempt, and they're still investing in these places, and they're consistently paying, higher returns. Like you said, in the sixes right now,
Yeah.
and now we're even seeing even this last few weeks or so. Now they're starting to say, well, with all this data coming out about jobs not being as bad anymore, and unemployment rate went back down again, a little 0.1%. And look, inflation's still an issue. Should we even be lowering rates anymore? Which, of course, guess what? Helps life insurance, right?
Oh yeah.
So we're starting
Yeah.
to see that happen too.
Well, and even from when we, closed on our house a month ago, I mean, rates were still not great, uh,
Mhm.
but they've gone they've gone up even more just over the last few weeks with that good news, right?
Right. Well, I remember even when the rates bottomed out, I remember talking to one of the CEOs of an insurance company we use. And this was back in like after 2020, going to 2021, really 2022, before they started raising rates.
Hmm.
And they were even saying, oh, rates have been so low for so long. We might have to lower that dividend rate down to 5.5%. And they're
Hmm.
like, and this goes on forever, 5%, which, when you think about it, like, wow, like that was dirt cheap rates. I mean, the interest rate was at zero,
Yeah.
right? And we weren't getting paid. We were getting paid nothing in
Yeah.
the banks.
0.01% in our savings accounts, right?
Yeah, exactly. And they're
Which
saying,
is
oh,
where
we're
they're
going to pay
starting to go
five.
again. I don't know about you, but I've had money in a handful of other high yield savings accounts, and I feel like
Mhm.
every other week I get hey, by the way, we lowered your interest rate down to this now.
Yeah. Oh, even the one that I've recommended to so many people is already lowered down to 3.8, while
Yeah,
I'm earning 6% on my life insurance, right? I'm making a lot more there.
that's why I don't keep too much in the bank. I like to keep most of it in policies now.
Right. And like you mentioned too, with the tax advantage too, right? Like let's just say that they do predict 5% over the next, 10 years.
Hmm.
Now, if you're invested in the stock market, unless you've got a Roth IRA, that's the only exception here, right? But if you're got an IRA, 401k, or even just plain old mutual funds or stocks, anything like that, right? If you make 5%, you're going to have to pay tax on it later at some point. And so even say you do earn 5%, but then you get taxed. Let's just say your tax rate's around 25%, right? I'm rounding here a little bit. Because it could be 24, could be 32, 38, whatever it is that you might be in. Still, let's just say it's a quarter. Well, what's a quarter of 5% that you lose in taxes? Well, that's 1.25%. So now you just net at 3.75. You can make almost double that interest rate in life insurance, letting it sit there and taking less risk than you would in the stock market. Because they're saying 5% average at most, right? There's someone predicting 3% for the next 10 years. Well, what happens if the market goes down in those years? That's including ups and downs years, ups and downs, up and down years, right? In years that you have good and bad. Obviously, they're saying it's going to be relatively flat with slightly up. You got to take that into account. That's a big deal.
Well, and it is hard to count for that when you see an average return, which is what's usually advertised.
Yeah,
It's hard to factor in the actual return you're going to net,
true.
especially if you're not considering, your effective tax rate or marginal bracket. Um,
Paying a
yeah,
financial advisor to get that bad return.
exactly. And then
Yep.
not to mention the other fees that may be coming out of that as well, whether
Right.
they're, disclosed or maybe a little harder to find.
Yeah. Well, especially when 401ks, I mean, I've done several episodes on the show where we've talked about Fidelity's target date retirement funds have underperformed the stock market by over 2%. So
Hmm.
if you only earn, say the market does average 4%, that means, well, I walk away with 2% a year average. I might as well put that in a CD or savings or somewhere
Hmm.
tax free like this, right?
Yeah. especially when there's these big shifts. If you've got all your money tied up in illiquid assets or qualified plans, it's hard to jump on those opportunities.
Yeah, it does. Now I know we've kind of been talking back and forth for a while now on this episode here, but you know, I guess the next question for you, Parker, is, you've worked with different groups. I know you and I both have a history. We both had ties with like Garrett Gunderson back in the day, and things like that. And now we do what we do. What do you think? And obviously, this is full disclosure, guys. Yes, we do offer life insurance. If you couldn't tell that already, yes, we do life insurance here, among other things, of course, with passive income. But Parker, I mean, what do you say sets us apart? Like, what makes us different or even better? And trying to do as much of a humble brag as possible here. Like, what do you say sets us apart from everybody else?
Yeah, it's a good question. Uh, your dashing good looks and my witty banter, that's what separates us. Or is it the other way around? I can't remember.
Yeah,
But
I can't
I,
remember
th-
either.
I
That's
think,
why I was at my age.
yeah. Well, I love the room that we have to. Obviously, it's hard in the beginning or in early days. Where we create the most value is just doing literally the best possible that we can. And I think that's what's been hard for me over the years, especially starting my career. Is I mean, girls got to eat, right? And now I got a family I got to provide for, right? So it's hard to literally cut out as much of the cost, fees, and commissions baked into these plans and make the least amount of possible so that it works the best for the client or the consumer's perspective. And so what I love about what we do is, I mean, I spend most of my days in software and illustrations and comparing plans from one another. And I love that I get to do the same plan for people that come into me looking for a plan as good as I can do for myself or a family member, right? And so I think there's a lot of plans out there that they're good client, you know, plans, but it's not what I would have done for you that I would have done for myself, right? Or that I would have, hey, I'll hook up dad or brother or sister, right? Or my buddy, but you're going to get what I, serve to everybody else. That looks good enough that, it can be a little complex and convoluted that you're probably not any wiser to know whether I've ripped you off a little bit or a lot of it
Mhm.
until maybe years down the road when it doesn't matter and I've made my money anyways.
Right.
I love when people come in either with plans that they're looking at or policies they've had for years, and we can show them pretty quickly, uh, not just by telling them, but by educating them so that they have the lens to look through and know whether they're getting a good deal or not. And whether it's us doing it or somebody else doing it, they can tell pretty quickly a good plan versus a bad plan.
They're not
So
just taking our word for it. Like, it's not just us saying it's better. They can literally see it's better.
exactly. And I'll get, conversations where somebody's, hey, I'm not buying anything today. I'm just shopping, right? I've got all these plans. I'm going to shop with 20 other people. And I
Mhm.
encourage people to do that because I love when they come back and say, oh yeah, you're right. You did the best from your first shot. Right. And these guys stumbled over their words because, I showed them that, hey, couldn't it be a little bit better here? And, oh, yeah, I guess it could be a little bit better. Let me redo that for you. That person would have lost my business right away.
Yeah, it kind of made me laugh. It reminds me when you said that of I won't say who it is. Somebody that's very popular in this industry, and she had sent an illustration to them. You sent your illustration. You copied me on it, so I got to see it. The conversation happening, and yours just destroyed her plan, right? Which I wasn't surprised by because she's one of those that believes it should be a high cost plan. And then she came back with new numbers, actually upset by it because she saw your numbers. So she came back and gave him new numbers, and it still wasn't as good as yours. But she's like, "Well, you should still just do what I do. You should just take my plan anyways." Which
Yeah.
obviously they didn't. But it's so fascinating. Like I love, and that's one thing I know with you, Parker. It's always fun is that we've had so many people, so many times where they've went to use some of these popular infinite bankers and their companies they're referring to, and then they keep coming back saying, wow, you're actually right, you guys are the best. I can't believe it. And like this is saving me literally not just say tens of thousands or hundreds of thousands over the lifetime of my lifetime, but sometimes thousands of dollars a year right now.
Yeah. And the crazy thing is it still happens literally every week. Uh,
Yeah.
I mean, just last week, I got a 24-year-old just bought a policy. He's putting about $7,000 a year, just fresh in my mind. And it's with one of these big four insurance companies that's mutual. And
Mhm.
on the surface, they look awesome. They check all the boxes. They got the history, the strong dividends, everything. But I ran exactly the same numbers on how I would design it if I were doing that policy for myself or for him.
Mhm.
And 24, I remember he was showing funding it until like 65. And in our design, with the exact same inputs, had a little over $300,000 more in cash and over $500,000 more in death benefit that was paid up.
Yeah.
So that doesn't always happen, but it's pretty cool to see that not only can you get just as much coverage as you were hoping to have, but also have way more money in the short, medium, and long term.
Right. That's I think a big distinction too, because so many people say, "Oh, well, you guys are just minimizing the death benefit, and that's why it's so cheap," which is true. That's our
Mhm.
secret sauce, so to speak, right? Is like
Yeah.
we're trying to lower the cost of the policy, which means lowering the death benefit. But in
It's
many cases, it also
just like
bumps it
this.
right back up.
Yeah. Yeah, exactly. Because we're earning so much more in interest and dividends on the cash value that get reinvested back into the plan. And naturally, it has to increase the size of the policy. Otherwise, it would cease to have some of the same, tax advantages and asset protection that it carries.
Yeah. And the crazy thing is, even when people are looking at term insurance, still we're like beating term insurance quotes they're getting from guys that's all they do is term insurance. We're like, by the way, this is not just term insurance that would be cheaper per month or per year than what you're paying, what you would pay with this other group. But then you can convert it without having to reapply your health into a better whole life plan, into an infinite banking plan down the road without having to take tests again or,
Yep.
measure your health and make, even if you were on your deathbed, you could literally convert it to whole life and then and you would get the whatever rating that you got in the first place.
Oh yeah. Yeah. And we end up doing that a lot for folks too that maybe don't have the cash or the income to save a bunch of money into one of these plans just yet. We can use that as a placeholder and protect their health or insurability for the next 10, 15, 20 years until they're ready to do it. Or maybe a young family is a common situation I'll see where, yeah, we can start maybe a small whole life policy or two, but that's not going to cover the mortgage, right? Because we're stripping out
Yeah.
the death benefit, and so we'll do a convertible term to bridge that gap, get them the coverage and protection they need, and then when they're ready to do another one, when debt gets paid off or they increase their income, they come back and yeah, they could be fat, sick, ugly, three arms and one leg, eye coming out of their forehead. They're not going to get denied for the best health rating that they got approved for before.
The good news is ugly does not affect your health rating. I know because I've gotten the best health ratings for several years without even having to take the poke and pee test.
That's
And
right.
if I'm proof of ugly that can work, I can guarantee, ugly is not a factor here.
That's right.
They don't even
Public
know what I
service
look like. They
announcement.
don't get a picture.
Yeah.
Well, I'll tell you, Parker, I appreciate your time here. I'm going to kind of, wrap up as kind of what we're talking about our conversation, talking about, could life insurance even beat the stock market in the next 10 years? Sure. Long term, maybe not, maybe not. That's possible. But shorter term, it definitely is looking that way. But even more importantly, I was having a conversation with my wife, and just so you know, and you know this, Parker, I'm saying this just so you know for the rest of you watching this or listening to this right now. My wife was a Dave Ramsey disciple. Like she was the first person approved in the state of Utah to become a Dave Ramsey facilitator. A Dave Ramsey counselor, and so for her, even to this day, she still's like, I don't know if I fully understand this infinite banking thing you talk about. Well, just last week, we're talking about, just money, where to move it. We're like doing some other investments, put some money in different places. And then she's like, you know what? I'm not feeling comfortable about banks. I don't know why, but right now, just intuitively, I feel like there's something wrong with the banks. And I don't know if I even trust FDIC anymore. She's like, and by the way, we got some accounts that are kind of pushing towards those limits. Maybe we should get money out of there, but where do I put it where it's safe? She's like, I don't trust anything in the real estate market to be 100% safe, even right now. So where can I put my money where I know I can get to it? It's liquid, just like a savings account, but pays more than what the savings accounts are paying us. And I even showed her the 3.8% savings account I had. She's like, well, that's better, but can we do better than 3.8? I
Hmm.
said, yeah, it's in the one place that Dave Ramsey told you not to put it in, which is life insurance. Like literally there's some extra room in my life insurance policy. We could pay off a loan that we got, small loan that we have in the policy. We could do that. And the money's liquid and available and it's making tax-free returns. And she's like, I need to take another look at this thing. She's like, maybe I should reconsider this and maybe we should be doing this on our kids more. I'm like, mm-hmm. That's right.
Yeah.
So I mean, I'm telling you, like I'm hearing a lot more people say the same thing. They're not trusting banks as much anymore, which we've been
Mhm.
saying for several years. And the stock market is actually just so overvalued. It's so unpredictable. That's not a safe place to store it either. And we're watching the interest rates come down in banks and in money markets and everything else. So even if you have a brokerage account, you're still watching those interest rates come down too. And so it seems like really all signs are kind of pointing in this direction, isn't it?
Oh, yeah. Even if you went and looked at the FDIC.gov website on the reserve ratio for how much money they need to have in reserves to pay the promises on those 250K thresholds,
Yeah,
that might raise a couple of alarms, and maybe not feel as safe as we thought with all that money sitting at the banks. So yeah, I mean, with all the things that are happening now, it just makes it an even greater case to have capital stored in this policy. But it's not giving up the opportunity to do something else with that dollar. And that's my favorite part is it's like having your cake and eating it too, but with your savings.
that's
And
right.
as much as we plow into these plans, it doesn't mean that that's a percentage we've allocated towards this bucket and that's just the end of it. It's really just the beginning of it because now we have an increase of that dollar, not only in value, but also in return and access to go do something else with it and still earn interest on it at the same time. So
That's exactly it. Yeah, you can earn a much higher return potentially than what the market will do in the next 10 years. And even more than that, you can even invest in other things that are like good assets like real estate backed investments and whatnot that have lower risk but higher
mhm.
returns. You can still do that too.
Yeah, exactly. And if not, it's a great place to just park it and store it till you're ready.
Yeah, totally agree. Well, again, Parker, appreciate your time, man. Time flies when we're having fun, especially
I
when
know.
we're nerding out on this stuff, right?
Well, we'll get back again soon here. There's lots of stuff going on to chat about. So
Exactly. All right. Well, guys, if you ever have questions, I mean, you want to connect with Parker, honestly, you just go right to moneyripples.com. There's an infinite banking section. You can actually book an appointment right from our website. So if you've got questions or you want to see what it looks like for your situation, kind of a no commitment, free consultation, you can do that right there again at moneyripples.com under infinite banking. So again,
yeah,
Parker, thanks for your time.
yeah. Looking forward to geeking out some more.
Absolutely. Everybody else, remember, it's not about just what you learn on the show. It's about what you're able to do with it, make it apply in your life. So go and make it a wonderful and prosperous week. And we'll see you later.